Okay, the participants are still coming in, but it's 4:01 London time, so we'll kick off. Good afternoon. My name is Crawford Spence. I'm a professor of accounting in the business school, and I'm delighted today that we are joined for this KBS conversation series with Philip Keller, who's going to talk to us about the transition from an investment company through to an asset manager via some turbulent times as well. Philip was the CFO, so Chief Finance and Operating Officer of Intermediate Capital Group, which is now a FTSE 100 investment company, and he held that position for over a decade. Today, he's going to share his experience of guiding the business through a period of very rapid growth as the company redirected its strategy in the wake of the global financial crisis. As investors flocked into alternative assets in a zero interest rate environment following the global financial crisis, the company had to build its product offering along with a marketing and operational infrastructure to benefit from market tailwinds. Prior to ICG, Philip was CFO of ERM Holdings, which is one of the world's largest environmental consultancies. And in his spare time, he's an amateur conductor and is currently studying for a Master's in Music at Durham University, which is his alma mater. But beyond that, he is also one of the school's executive fellows. We have 7 executive fellows, all of whom have had an illustrious career in different industries, and they provide strategic oversight for the school's activities and contribute to enhancing our student experience in various ways as well. And this is one manifestation of that today. So also joining us is Malika Yunusova, who is doing an MSc in Finance and Analytics. She has some experience in financial advisory services with Ernst & Young and is doing a degree with us just now to broaden her knowledge in financial analysis. She's also an active member of the Socially Oriented Society, organised by BCG, so Boston Consulting Group, I guess that is.
That's correct.
She and other motivated individuals help non-profit organisations launch fundraising companies. So how we're going to work this is Philip's going to talk for about 10 to 15 minutes. I may butt in at various points to ask him for points of clarification, but I'll try to avoid doing that. I'll then ask him 1 or 2 questions. Following his talk, I'll pass over to Malika, who will also offer some reflections on Philip's talk and maybe ask 1 or 2 questions before opening it up to the floor for some Q&A. So please submit your questions via the Q&A function and we will pick up as many of them as we can. I anticipate us having at least 20 minutes for questions towards that time. Okay, so without further ado, I will pass you over to Philip.
Thank you, Crawford, and good afternoon, everyone. It's a great pleasure to be talking to you, and I'm thoroughly enjoying being an executive fellow at the business school. I've had a few very interesting discussions of this sort and plenty of challenging questions, which is great. So I hope we enjoy the next hour together. What I'm going to do is I'm going to paint a picture of Intermediate Capital Group as it was in 2008, 2009. I'm choosing those dates because it's just before the global financial crisis. And then I'll paint a picture of where we are now. And I'm sorry if I keep using the word we. I left the company 18 months ago, but I still feel quite attached. And just paint. So I'll paint a picture, sort of of the 2 points a decade apart, and then perhaps during the Q&A we can talk about what are the things that we had to do, what do we have to put in place, what were the challenges of making that journey. So in 2008, just before the global financial crisis. ICG was a public company. It was nestled nicely in the FTSE 250. Market cap was about £2 billion. And it was an investment company. And it was a very specialist investment company. So that means it gathered assets, which it held on behalf of its shareholders. It managed those assets, sold them, and then the shareholders reaped the benefit of those. So it was a business that owned the assets that it invested in, hence investment company. It was in a sort of fairly small niche, which is in the area of funding mainly buyouts. So we were in this area of private assets, and the distinction between private and public assets is that they're not traded, and assets that aren't traded is a different style of investment. So there's lots of large traditional asset managers, Schroders, Fidelity, Aberdeen, Standard Life Aberdeen, who manage hundreds of billions of pounds or euros or dollars, and they buy and sell shares and bonds on various exchanges. So those are traditional assets. What ICG did was deal in private assets, and private assets don't get sold share by share; they get sold as a whole entity. and they tend to get sold through M&A activity. So when you invest in a private asset, you need to think very hard and do a lot of work because the information isn't public. And then traditionally, the investor, such as ICG would hold on to those assets for 3, 4, 5 years or even longer. So it's a very long-term commitment and a long-term relationship with the company that we're investing in. And we would only realize that investment through some years later selling the company through some more M&A activity. So it's a very different style of investing that requires the investment teams very close to the assets. So they tend to need to speak the language, be in the country, probably know the CEO and the CFO, understand what it does, probably sit on the board of the business. So it's a very different style of investing. And the reason why I go into a bit of detail on this is because that's the main function of ICG. ICG is sort of the engine room of ICG now and then has always been investment teams that were dealing in private assets that get very close to the companies that they invest in. So in 2008, we had a balance sheet of about £3 billion. That probably represented about 60 investments in companies across Europe and Asia. We had about 10 offices around the world where small investment teams would get to know these companies and invest in them. So it's pretty niche investing. We had about 135 people, most of whom were in investment teams. And we were investing largely in businesses that were going through management buyouts or leverage buyouts. So we're investing in businesses that were quite heavily geared. In fact, we provided part of the gearing. The reason why it was called Intermediate Capital Group is because we were providing capital that was sat between equity and bank debt. So it was intermediate. And therefore it was higher risk than bank debt, but lower risk than equity. So we were providing this sort of this intermediate piece of capital to buyouts around the world through this very, very intense form of investing. But that meant that the underlying assets that we're investing in were themselves had quite a lot of leverage, had quite a lot of debt. ICG's balance sheet at the time also had quite a lot of debt. This is the balance sheet that I inherited. So going into the financial crisis, we had 3 billion of assets, most of which were geared, were in companies with a lot of debt, and we ourselves had quite a lot of debt. So suddenly going into a crisis which was fundamentally driven by the overvaluation of assets, initially mortgage assets, but then that spread across the entire system, was a very precarious place to be. And we spent a very difficult year in 2009 looking at the business model and thinking about how it should be funded and what we should be doing, because it seemed clear to us that we wouldn't be able to go back to a model that required us to have a lot of debt and we invested in companies that had a lot of debt, because that 2 layers of gearing looked too precarious in a world where asset prices had taken a massive collapse through the crisis 2008, 2009. And that was a real catalyst for us to change. We went from a market capitalization of about £2 billion in 2007 to January 2009, we were about £200 million. So we lost 90% of our market value over a fairly short period of time. Now, we weren't alone in losing value through the crisis, because all companies did, but financial companies did particularly. And there are some technical reasons why we were particularly hard hit, which I won't necessarily go into. But it was 2009 was a very tough year because the value of the business was very low. The basic business model, the basic essence of what we did was actually still very strong. We were still very good at identifying good investment opportunities, managing those investments, and making strong returns. So what was under the bonnet, what was the real engine of the business, was still a very strong engine. But we couldn't really build the capital structure. We had to rethink the capital structure and the business model to make best use of that. So that was where we were sort of 4 or 5 months into the financial crisis. Our balance sheet was about 3 times geared, which means we had 3 times debt for every 1 part of shareholders' funds. And I always reckon that 3 times represented roughly the number of hours sleep I got through 2009. Because as CFO, it's quite a precarious place to be in a heavily geared balance sheet through a financial crisis. So let me now roll forward 10 years, and I'm going to kind of skip out an awful lot of what went on in between, and hopefully we can cover it through the Q&A. The catalyst that caused the change was the global financial crisis and the change in the way the market saw credit and debt. And also our recognition that we needed to change our income stream based off the same fundamental competences that we had as an investment company, which was investing. And so the shift that we decided to make was to, instead of investing purely for our own balance sheet and therefore our shareholders, we would start to look to attract third-party capital. And so move from being an investment company where we're just investing our own capital to being a fund manager where we're investing the capital of a client base. Now that client base are basically the global institutions that the fund management industry as a whole service: pension funds, insurance companies, sovereign wealth funds. These are the big institutions that basically have all of the world's savings. And so we decided that we needed to attract that group as our client base in order to build a pool of capital that was off balance sheet and therefore represented a much lower risk for our shareholders. Instead of being a business that earned its income through investing and therefore taking a return on investment, we would earn our income through fees from managing other people's investments, but in the same underlying asset classes. So now ICG manages about 45 billion euros. It has a very profitable fund management company that's based on the fees that it receives from managing those 45 billion euros. And if you go to ICG's website, it will say that it's a global alternative asset manager in private debt, equity, and credit. That's what it is right now. And that, in fact, is what it was 10 years ago. But now ICG is doing it for third-party client base rather than for its own shareholders, but with the same basic competencies in investment. The big difference is that rather than just investing in two regions and in one area of private assets, the company now has something like 25 product lines as opposed to 2 product lines. So when we go and see clients, or the company goes to see clients, it can talk about a whole range of strategies, whether they're global or whether they're in buyout debt or property debt or infrastructure debt. There's a much broader range of private assets that we can offer our clients. So part of the job of the last 10 years is to build up more of a portfolio of products to offer this new client base that we've acquired over the last decade. So the company manages 45 billion euros. Its share price on Friday was £19, and so its market cap was about 5.1 billion. So if you remember, I said at the depth of the crisis, we were worth 200 million. Now the company's worth 5.1 billion. That has made it one of the best performers on the London stock market for the last 10 years. And it's the reason why it's now in the FTSE 100, as opposed to nestling in the back end of the FTSE 250. It has about 500 people. Now, that's still a very small number of people to be worth 5 billion of market cap. It's probably one of the highest value to employee ratios, I suspect, on the exchange, because it's very capital heavy and it makes money through managing capital. And now the competences of the business has changed. At the heart is still a very, very rigorous, disciplined and focused investment process. But now it's a machine that harnesses 25 different strategies as opposed to 2 different strategies. But we now have a very big marketing and distribution function, so we can talk to all of those institutions around the world who will give us their money to invest. And we also have about 200 people. The company has 200 people in let's broadly call it infrastructure, finance, operations, IT, regulatory, HR, risk management, all the things that you need to do incredibly well to be a well-run financial institution, to be a well-run financial company, and to be a well-run fund manager. So the business has changed fundamentally in the way it sees its clients and the way it manages and monitors itself. The underlying competency of the business hasn't really changed. It's broader because it's spread across more asset classes, but it's still fundamentally a company that invests in private assets. We just do it for a far larger client base. So the sort of indicators that the company will focus on in terms of managing its own performance and talking about its own performance and value to shareholders will be things like fundraising. So what funds are we raising? from our clients in order to invest on their behalf. Assets under management is a really important KPI. The fee rate that we can charge our clients for managing their assets. The profitability and the margin on the fund management company. So how much of that fee, how much do we retain? Various staff measures. ICG is a people business. I mean, so many businesses talk about themselves as people businesses, but fundamentally, when I say people business, I mean a professional service firm. Now, there's a huge range of professional service firms, and I worked for a consultancy before I joined ICG, which was also a professional service firm. Fund management is a particular breed of professional service firm, but it is still harnessing the talent of individuals rather than harnessing the talent of fixed capital. And therefore, staff measures like turnover and engagement are incredibly important. And also, ICG still has its own balance sheet, which it uses to incubate new fund strategies. So making sure that the balance sheet is safe, the gearing levels are reasonable, are also incredibly important as a KPI. So I've kind of given 2 points, Crawford, of where we were 10 years ago, where the company now is. And I've talked not really about the journey in between, but what happened in between was that there's a huge amount that we had to build up. And that came, and I think we should maybe touch on a few of these, but it came in the form of bringing in new products, building up a client base, building up the infrastructure, and I've hinted at all of those. But I think fundamentally it was also dealing with the cultural change of doing one thing in incredible depth with effectively no clients, to doing 25 things, all with the appropriate level of depth, but with a third-party client base. And how did we take our staff and our shareholders and our clients on that journey with us was kind of the excitement of the 10 years from 2009 to when I left ICG in 2019.
Yeah, so I mean, I think that's absolutely fascinating, Philip, and in particular, latching onto the people's business phrase that you used there. We're into talking about that sort of thing and cultural change and managing people in business schools, but we tend to segregate it out. So you can go and study HRM if you want to talk about that, or leadership. When we teach people about finance, we teach them about, maybe the transitions from being an investment company to a fund management company. We tell them about how to price derivatives, all that technical stuff, analysis, valuation. What we don't tend to do is meld the two together. But of course, all organizations, whether they're in the finance field or not, have people that they need to manage, and they have organizational cultures that they have to deal with. So I'm wondering if you could talk a little bit more about that transition and how that took place.
Well, I think this is probably the most interesting and sort of stimulating part of the journey, really, because what we had was we had a platform, and we had to take our existing team through a change where they were looking at their activities and their clients shifted. So clients before was where you got deals from, and then clients had to be actually where you get capital from. So that was a big shift. And suddenly the heroes in the business weren't just the people who did deals, they were also the people that won big mandates from clients. It's a completely different skill set. It was a different team. So part of the cultural shift was trying to make sure that different competencies were actually seen as being equally important. So I think there's the shift of culture generally, but there's also the shift in culture that comes when you bring in new teams, or when you create new teams. So we went from something like 3 strategies to currently, let's say, 25. The way we brought in new strategies was either recommissioning someone who was doing something and ask them to do something slightly different, or do it somewhere slightly different. That's kind of easy. Or you bring in a team from another organization that's a bit lost, and you bring them in. That's culturally more difficult. Or you bring in an entrepreneurial group who are trying to do it themselves and aren't making headway, and you bring them in. That's difficult. Or you do an acquisition. That's culturally difficult. So of the big increase in people in the company, quite a lot weren't recruited directly, but were recruited through bringing in new strategies. All of that represents cultural stretch. And that's at a time when the business itself was having to reorientate around who were the heroes, who was really creating value in the business. because it had always been the deal makers. And suddenly it wasn't just the deal maker, it was the client relationships, or it was someone who could structure a new fund, because structuring funds is complex. It's done in dark rooms with lawyers, but it's bloody difficult, and they're very complex vehicles. So if you can do that efficiently and quickly without making mistakes, that's a heroic act in itself. So there was a cultural shift, and then underpinning. So you have business objectives and your communication, and you have all those leadership challenges around explaining how the business is moving forward and how these competencies all fit together. And I think part of what we did was try and make sure there was trying to retain a very collaborative spirit in the company, which financial services actually is not well known for collaborative spirits. There's a term that's used within almost every financial service firm of back office and front office. We've largely banned those terms, and what most firms would call back office, we termed infrastructure. And it's a small thing, but culturally, it makes a big difference when someone feels that they're talking to a colleague in infrastructure, or an infrastructure colleague's talking to an investment colleague. They don't feel quite the sort of hierarchy that back office and front office conjures up. Now, I'm not saying that everyone was beautiful to each other and everything was harmonious, but it is things like that which was a conscious effort to make sure that everyone understood that there was a machine that needed all the cogs to be turning in the right direction. And then you have this, it's in every company, but it's particularly in financial services, this sort of cultural wraparound of remuneration. And every individual is motivated by a range of different things. And there's a whole spectrum of strength and motivation by remuneration within a company. That's always going to happen. But a lot of people will at least pretend that remuneration is very important to them because they think they're negotiating. So we had to think about how remuneration moved on, how we brought in new strategies, and then how we also moved our colleagues forward so that we could have something that was as collaborative as possible as we were stretching the organization. Because it was a very stressful exercise to keep bringing in new fund products, because fund products, each one reports in different ways, they're structured in different ways, they need to be absolutely immaculate in the way that they're structured and they're operated, and it's in a very heavily regulated environment. So a new product it's not just recommissioning a production line. And as you're going through all of that, it's very stressful because you equally don't want to keep throwing more people at the problem, because that's also demotivating. So it was very exciting, but I think it was much more of a cultural and HR challenge than anything else. And there were moments of real stress. Some of we did very few acquisitions, for instance, because acquisitions are the most culturally difficult, particularly in fund management. Some of the best ways of bringing in new teams were very, very entrepreneurial teams that had tried to go it alone and didn't manage to raise any money. So we had almost developed a plug and play kind of situation where we could bring a team in and say, all right, you go and see Fred and they'll help you with distribution, and Joanna will help you with operations, and Charles will help you with regulatory, and Anna will help you with IT. And immediately you could just say, here are 5 people that are going to set you up within 2 weeks. So all the things you couldn't do alone, you can now do with us. So we had these entrepreneurial little fund management silos that suddenly were very grateful to be in something that was larger than they were, but not so large that they would get lost. And so my last point on this, because it's a very long answer to your question, Crawford, I've found that the perfect size of business for me is to be in something that's small enough that you almost know everyone and you can affect change quickly and you can put your arms around the business, but it's large enough to be interesting. And I think companies that are sort of 100 to 700 are in that range, people. You can obviously it depends roughly what they do. I mean, the ICG at 500 people is still in that range. Certainly at 135, it definitely was. And that is kind of the most rewarding. I've worked for GlaxoSmithKline, and I've worked for some very large businesses. I've worked for very, very small ones. But that size, I think, is really exciting. And I think it's exciting for everyone. It's not just the executive directors, because the visibility of what's going on around you, your access to everyone in the company, and yet still feeling that there's something important the company can do. It's the most rewarding size of business I've found. And that's probably a personal reflection.
Okay. And can you say something about investor pressure and how investor relations maybe changed over, say, from 2010 up to 2020? So you've obviously had the transition from one business model to another. You've also had, phenomenal growth as well. And, obviously you weren't there when the company transitioned into the FTSE 100. But, I think they were still managing about 45 billion of assets at the point when you stepped down as CFO. Does that mean you have a more concentrated shareholder base, a more active shareholder base, or on the contrary, do you start to get included in all sorts of passive index vehicles, which means that investors are not quite on your back in the way that active fund managers may be?
I think the latter point is definitely right. Although we will be in more indices now than we were when I was there. The main change from the investor base was the IC investor base was largely UK blue chip and long-term. It was long-term institutional, and I'd say of the top 20. There wasn't much turnover. So the top 10 were represented by about 20 institutions for most of the time I was there. What I found was that they took a long time to understand, to believe the fund management story. So they took a long time to perceive the change from investment company to fund manager. Once they did perceive it, and it started coming through in some of the KPIs that I mentioned, the share price literally took off. But I don't perceive there's been much change in the profile. There was one thing that we did consciously, which was from about 2015 to 2019, we had a major push to build up the US shareholder base. And it went from about 7% of the book to 22%. And that's a long-term labor of love. And we did that because we just wanted to, we felt that the US shareholders understood the business well. They're very good at perceiving value. They have a much deeper bench in terms of following financials because there are more of them over there. And so they have more specialist fund managers and more specialist analysts. And we wanted to be covered by those. Let me also answer a question aligned to that, which is the change in how the investors in our funds as opposed to the investors in the company. So what you're asking about, Crawford, is the shareholders.
Yeah.
When I think of investors, I actually think of the clients, the institutions that invested in the funds. And there was also a change in their approach to the business over the 10 years that I'm talking about. At the beginning of those 10 years, they were focused wholly on investment teams, investment track record. How do you invest? Can we talk to the individual? We want to see the whites of their eyes. They were only interested in investment capability and track record. We then went through a few years later where they got very interested in risk management, operations, regulatory, IT and systems and reporting. So all of that infrastructure stuff started. So in a 2-day due diligence trip, they went from being 2 days with investment teams to perhaps 1 1/3 days with investment teams and 2/3 of the time with what we broadly called infrastructure. And then if you go now, I suspect it would be about 40% investment teams, maybe 50% investment teams, 25% operations and infrastructure, and 25% ESG. And that's gone shooting up the agenda.
That's really useful to hear, I think, for students on the call, because we have a tendency to probably just present to them the front office activities in finance classes, but actually infrastructure is a growing area, and something that many people should be looking at in terms of career, particularly as things become more and more mediated by technology. Okay, one more question from me, and then I'll hand over to Malika. And note to the audience, please do start posting things in the Q&A, and we'll go around to those very shortly. Okay, so you mentioned gearing levels and debt to equity. This reminded me of when I was an undergraduate in the late 90s, and my finance professor said the ideal gearing ratio is one to one. Yeah, anything beyond that is not good. And I think finance textbooks might still say something similar, or 2 to 1 is a red line you should never cross. So you're saying it was 3 to 1 at one point at ICG, but equally that's quite low compared to a lot of financial institutions, the levels of gearing they were exposed to around that time, particularly in the US. So I suppose my question, and debunk it or laugh at it if you want, is what is the appropriate sort of debt to equity ratio, if there is such a thing?
Okay, so 3 to 1 is what we ended up as after taking write-offs on the book. Okay. And it wasn't designed to be 3 to 1. And funnily enough, in about 2015, I set a gearing range that I wanted us to operate within at ICG, which was 0.8 to 1.2 times, which was derived from a lot of financial modeling, not because it perfectly bridged your professor's estimate of 1 to 1 being the optimal level. My belief is that you only determine the right level of gearing through a lot of modeling and a lot of downside modeling, and probably discussions with the rating agencies, because they may be important stakeholders in your gearing levels. So if you want access to capital, debt capital, you need to make sure that your gearing level is comfortable. But then your shareholders can't. Let me put it this way: in terms of the appropriate level of gearing, all those things matter. My finance professor from at least a decade before you said, I remember this, virtually anything I remember from my undergrad degree, was there are 2 rules in corporate finance. Rule number 1, don't run out of money. Rule number 2, maximize ROE over the long term, subject to not breaching rule number 1. And gearing is all about not running out of money, but also optimizing ROE. Because the more gearing you can put into the business, the higher you can leverage, and the higher you can force up shareholder returns. But you need to do it in a way that is responsibly thought through, and the quality of your business model, your forward planning business model, the quality of the spreadsheet, the quality of the inputs, the amount it's updated, the amount it's understood, the integrity of it. That's really, really important. And there are percentage points. There are percentage points of shareholder return resting on that calculation. So you can be a percent on shareholder return can be very hard to obtain through building up new fund strategies and distributing them to clients, and getting fees for managing that fund for 10 years and then setting up the next fund. Maybe you'll get 0.5% if you do that really well. Equally, you can get it immediately by a sensible level of gearing. So I always think no gearing is not a good idea unless you're a startup or in a very risky business. But ultimately, the answer has to come through very good quality modeling and stress testing.
Okay, thanks a lot. I could push you on this for a long time, I think, but it'd be unfair to the audience. Malika, do you want to come out of the woodwork, put your camera on, and offer any reflections or questions you have of Philip before we open up to the floor?
Yes, of course. I actually have a great question for Philip. Could you please elaborate on overcoming a personal, perhaps ethical crisis in that 10-year journey? For example, regarding an investment decision or something that you felt uncomfortable with?
Wow, you're right, that is a good question. We never really skirted that close. We always felt, the examples I can think of, I remember we spent a long time, and this is a long time ago, actually, this is probably before the crisis, may have been 2007, looking at a company, a cigarette manufacturing business that we didn't invest in, but that's not surprising. I don't think the business invested in anything that I think was close to immoral. that we didn't feel comfortable with. So I don't think I had any ethical crises there. I think managing people, and they're not ethical crises, but managing people always, over a long period of time, you're always going to kind of question yourself and question whether you're doing the right thing for someone's career. Managing a group of motivated people always presents crises. They're managerial and personal. They're not necessarily ethical. I'm not trying to evade your question. I just don't think ICG ever came close to investing in something that we thought was worthy of so much discussion. I could call it a sort of crisis or a big ethical decision. No, I really can't think of any.
What do you think? I mean, you obviously went through very challenging times with ICG. What do you think is the quality or maybe the tools that you have used to cope through stressful time?
My wife's a psychotherapist. That's helpful.
That's actually very handy.
I was very lucky that through the bulk of the period I'm talking about, there was a three-person exco, and we kind of ran the business. And I talked about the size and scale of ICG, and I think that was also pertinent. So there were three of us that ran the business. All of us were very knowledgeable about most things in the business. So I knew a lot about the investment area, and then my two colleagues, Christophe and Benoit, knew a lot about regulatory and operations. So all of us, because it was a small group and we met very often, between twice a day and twice a week, it meant that the efficiency and velocity, and I think probably quality of decision making, was very strong, and that was okay in a business that was of that size and scale. And what that also meant is that we were very well supported by each other. So there was a real merit, and I think that's the biggest tool, the biggest thing that I could draw upon, is I always felt that the other two, that between the three of us, there weren't politics. And we all knew enough about each other's area to have good, robust discussions. And my French, both the other two were French, they won't mind me saying that they culturally felt very comfortable with arguing. I'm English, so I feel very uncomfortable arguing. And without wanting to stereotype, that did happen. So we would argue a lot, but it was all fine. And but always felt supported. And what that meant was that we could really get on and think about running the business in the best way possible. Now, there's a downside to that construct, which is it's a bit exclusive. It's very effective when you're building a business, coming out of a crisis, going through rapid growth, making decisions around what teams do we bring in, what do we invest in, where do we put the new marketing resource, where our gearing should be. If you want to do all of that quickly, then having three people, well-informed people who get on, making decisions rapidly is very, very effective, but it does disenfranchise a broader group. So that also was something we had to think about. And we did that through other mechanisms by creating a culture that allowed each of these funds to operate as fairly independent silos that gave them also their own. So the very talented investment people that we had felt that they were also in control of their own area and their own destiny to an extent. So I think that the most important tool was the fact that for a longish period of time we had the decision-making and leadership construct worked very well. And I also had a really, really fabulous head of HR, who is a colleague I will, we all relied on immensely, and she was brilliant. So she was where, when we all had enough, that was where we would go to, not generally one at a time. So there was a lot of support within the business. And again, that goes to size and scale. I would hate to have gone through that sort of rebuild after the crisis in a company with 5,000 people. Yeah. There's other things, to me, but they're all personal. Music, my family, But if I think about what's generic to us as people in business, it was the things that within the business that supported me was to do with the organizational construct and how we all got on, and the sense of purpose and I felt very, for most, except for 2009, I felt very energized throughout the whole period.
That's amazing, actually. Thank you for sharing that. I also have again, one a little bit maybe personal question. You said that you worked in environmental consulting previously. Do you think this experience was actually useful for you to implement some of your knowledge in your career and job in ICG?
Being an environmental consultancy didn't really help because I was too distant from the engine room. Whereas as an investor, I could sit on an investment committee at ICG, but I couldn't go and really do any consultancy because I wasn't qualified. So I was a bit more distant. What it did teach me was I understood the mechanics of buyouts because ERM went through 2 buyouts at either end of my tenure. And it meant I understood the world of buyouts really well.
Okay.
And the fact that I'd been on the management side of a buyout gave me some credibility within ICG, that although I hadn't seen dozens of them like some of the investment professionals had, I had actually been in the guts of a buyout, and it was a successful one. So over my 6 years there, I did one after a year and one after 5 years. So I think it was more around that understanding of global businesses, something around professional services and dealing with people with knowledge-based businesses. But I think the most importantly is understanding the dynamics of leverage buyouts.
Okay, thank you for answering that. And we have another question from students. They're asking, what is your opinion on the progress current financial institutions make to actively shift funds towards sustainability, considering they might not be able to be number one choice from a profit perspective?
I don't know the current stats around the success of sustainable funds, but my guess is that the delta is narrowing, if indeed it exists at all, because it is now such an expectation of socially responsible investing is now it's almost become entry level for a lot of clients and a lot of shareholders. So that means that there is a selection towards those businesses that are meeting criteria that allow investment companies that attracts investment companies. So everyone is being dragged up, so that I don't know that the delta is so great anymore. So in the old days, in 10 years ago, sustainable investing meant literally investing in sustainable technology. But I think the bar has risen for almost every form of investment, that it has to have ESG principles, culture, and procedures that get tested upon investment by almost anyone now. So that's whether it's traditional investors and probably most notably BlackRock and Larry Fink's annual letters, through to much more activist investing like ICG does, where they'll say, if you're not, we'll invest in you, and if you're not, if your ESG processes aren't really up to scratch, we're going to help you get there to the investee companies. So I think everyone is being lifted up.
Okay, so we've got a question as well here about private equity. So it's a sort of career-related question where someone's asking, there seems to be a high barrier to entry in the private equity space. How can fresh graduates break into that?
Well, funny enough, this came up the last time I chatted with a group at King's. There are very few graduate jobs, I believe. What I've said before is by all means you should look for those graduate jobs that exist, but most of the young talent going into private equity will go in via an investment bank or an accounting firm or a law firm or a BCG or Bain or a top consultancy. So my advice would be apply for private equity, but as a dual track, apply for one of those 4 or 5 areas with a view to your next step being private equity.
Okay, that's a very clear answer. Thanks very much. And one more thing, because we're talking about careers, going back to your nice distinction between investment and infrastructure. Just what would you say to, sort of hungry, soon-to-be graduates from King's Business School who are looking for a career in finance? Where are the opportunities going to be in the future? I mean, I think we tend to sell them dreams, or they arrive with dreams about working in the investment space as opposed to infrastructure. But really, should we be thinking about flipping that on its head? Is the future going to be more in the infrastructure space? What's your views on that?
The areas of infrastructure that have been growing rapidly are risk management, regulatory. And so as someone who's recruited for a long period of time across that infrastructure space, specialist fund knowledge and specialist regulatory knowledge is definitely at a premium. I think though for individuals, they also need to have a sort of realistic assessment of who they are, because I think being an investment professional doesn't just require a certain skill set, it requires a certain sort of character. So you have to thrive in a transaction type environment where many of your transactions may be unsuccessful. So and in some funds in ICG, someone could slog their heart out for 2 years on 6-7 deals, really believe they're about to strike those deals and not do any of them, and still pick themselves up on day 1 of year 3 to do the same thing on the next deal. Now, some people thrive on that, and some people thrive on the idea of having those bursts of working incredibly hard and really fighting and with sharp elbows for your deal and being in the trenches with your team. And some people thrive on thoughtfully sitting at their desk working with lawyers to structure a fund, which also needs to be done to a deadline. But you know that if you are thorough and you get through it all and you work well with the lawyers and you work well with your colleagues, you're going to produce a beautiful fund vehicle. So I mean, you're right, Crawford. A lot of people just see all of the glamour in the investment side, and it probably is. But I think people need to have a realistic assessment of what they are. I personally know that I would not want to work in that sort of transactional environment. I like doing a transaction about once every 5 years, but I wouldn't want to do it all the time. And I certainly wouldn't want to do it where you may lose 5 out of 6. So I think if you made that assessment and you feel that actually you're a person that works well within a team, you like to carefully go through and build up something of value that's difficult that you can receive plaudits for because you've done a great collaborative, intellectually interesting piece of work, then you're better off in fund structuring or in regulatory. If you love dealing with people and telling them how, and have that enthusiasm for marketing a company's products, then you should be in marketing and distribution. And it's a bit like a rugby team.
Don't talk to me about rugby. It was a bad weekend for Scotland.
Well, for the first weekend, I actually can talk about rugby. It is literally as different from being a fly half or a winger and a prop. You need to be realistic about where's your skill set. I think it's a great industry to work in, and it actually does take a whole range of different talents, and it can be incredibly rewarding in areas that aren't necessarily doing investing.
Okay. Is there any more questions?
Yes, I would like to ask a few more questions, if you don't mind. I'm very interested to know what is your opinion, what would be the effect of Brexit on ICG performance as well as on UK economy and labour markets?
Oh, it's so broad. Can I just talk about ICG?
Okay.
I will. I'm not a fan of the concept, just to lay that out there. And I think a lot of when it happened, we did a lot of Brexit planning, and the most obvious ways of things changing are is that the marketing of funds has to be done from within Europe rather than outside of Europe. Broadly, I mean, you can market from the UK, but it's just harder. So the first area really needed to look at was how did we market our funds and where did we manage our funds from so that we could market to European clients. ICG already had offices around Europe, and in fact, there have been periods of time where the French team have been more productive than the UK teams in some strategies. So, and there's also a big presence in the US. And of course, all that happens is the UK becomes the same as the US, really. So everything is manageable. It just is harder. So I think for a company like ICG, it's a logistics problem that is not that difficult to solve. It's, there's probably a bit more friction, but there's not much more friction. So from what I can perceive now is I don't think that there's been any major hiccup. I'm an outsider now. I haven't seen any internal papers for a year and a half. But when I was there, until I left, it seemed like we thought about all of the issues, we'd solved them logistically, operationally, and it looked like those issues, those plans were fine. So I mean, it doesn't look like it's having a massive impact, but I'm sure the company would have made its own statements on this.
Okay.
More recently than my departure. So it's something we spent a lot of time planning, and we're able to slot everything into place.
So you were able to kind of start preparing for it in advance. So now.
No, we started preparing for it on June the 24th after we stopped swearing.
Okay.
As I said, my two very good friends, who are both Parisians living in London, and myself were somewhat distraught.
We have another question from students. How do you think after COVID influenced the working schedule and logistic operations at ICG?
Well, I've probably got more current experience with my non-exec role at John Laing, where I chair the Audit and Risk Committee, which is also a FTSE 250 company, and it's an investment company. But if I look at my combined experience across those two, it feels like everyone's working pretty effectively from remotely, but it's not the full experience. I always felt that to solve complex issues, it's really good to have everyone in a room. But actually, in the last year, all of us have solved many complex issues in this format. It's probably not given us, the culture that I talked about a company that's small enough to put your arms around and large enough to be interesting. Well, I think you lose that if you're doing everything by screen.
Yeah, it's impossible to replicate this structure via Zoom. It's not the same.
All those advantages about knowing your colleagues, and also feeling you make a difference because of the size of the business, all that, the stuff that I think is that really is makes working in medium-sized businesses really worthwhile over a long period of time. I think it all gets somewhat homogenized through Zoom.
Yeah.
And I think that's the shame of it. I mean, you guys will have as much idea as I have as to how things will go back. My guess is it'll go back to more like it was, but not entirely like it was.
Yeah.
But I had from the time I retired in July until COVID the following March, I was on a number of boards, most of them charities. But the idea that everyone would join by Zoom was crazy. I mean, everyone would go to every meeting physically. No one ever asked whether they could dial in or go on Zoom. But now you can absolutely see that virtually every meeting, someone will probably end up dialing in. So hopefully we'll become a bit more efficient, but we do need to grab back that personal interaction.
Yeah, I completely agree with you.
You've worked at EY, so you'll probably know that.
Yes, that's completely something that you can't replace. Being in the office with your team in the same room is just, it's impossible.
At John Laing, we've recruited a CFO and a CEO who pretty much no one on the board has met physically. So Ben was recruited last summer and Rob was recruited a couple of months ago. And I mean, I happened to have met the CEO because he advised ICG through the financial crisis. But the board has literally recruited the two executive directors without ever meeting them.
That's risky, I guess.
But what else can we do? I mean, that's an extreme. I mean, obviously that in that situation, that wouldn't happen. You would always want to meet someone physically, even if it meant traveling across the world. But for most of the things we do day to day, it's not necessary.
That really makes sense.
And like you guys, I've been doing a master's degree by Zoom.
Oh, really?
Yeah, which has been very sad.
Yeah, it is. It is very sad.
I mean, intellectually, it's great. I mean, it's no different. You know, in terms of the substance, it's fine, but in terms of the experience, it's a shame.
Yeah, you don't get to meet other students and to experience student life actually. So yeah, I guess we're on the same boat here.
Yeah.
And Crawford, do I still have time to ask my last question?
Yeah, go for it.
Okay. Philip, I just wanted to, there's been a lot of talks about energy transition, and I'm just curious to know, what is your opinion about the energy market in 5-10 years, or maybe what is the ICG opinion about this topic?
I'm afraid I don't know enough about energy, and I certainly don't know what the ICG view would be right now, because I'm too long out of the business.
Okay.
Sorry about that.
That's okay. Thank you so much anyways for all your answers and for giving so much details. It was amazing. Thank you.
We've still got a couple of minutes, so I'm going to ask one more question about technology, and specifically how the fund management industry is being shaken up by technology and what your prognosis is for the future. You know, we're constantly being told we're in the middle of a fourth industrial revolution. Whenever I interview people in fund management or other areas of financial services, I don't come away with the impression that we're in the middle of such a revolution. So I was wondering if you have any view on what the key technological disruptions are in that space, and whether they're likely to be significant or marginal in the next sort of few years.
I can only really refer to the area that I know. And I think investing in private assets cannot be really intermediated by technology, because they're not tradable. So there's a big distinction between tradable assets and non-tradable assets. And my experience is entirely in non-tradable assets, where you just can't. There's no way you can avoid doing the work of getting to know the business, assessing the business plan, understanding where the risks are, structuring a deal to make sure your risk is mitigated, and fundamentally getting the right return for your risk. I mean, all of investment, whether it's traditional assets or alternative assets, public or private, all of it is around getting the right reward for the risk that you're taking. If you're in tradable assets, then your risk is always mitigated because you can sell. And I think computers can do more to help that algorithmically than in private assets, where I can't see there's any alternative than doing the work and getting to know the people in whom you're investing.
Okay, that's great. So guys, you heard it here first. The robots are not coming for non-tradable assets. Okay, I think that's as good a place as any to sort of wrap this up. So Philip, thank you so much for coming and joining us today, and I'm sure the audience really got great value from that. And Malika, thank you so much as well.
Thank you for having me.
Thank you, Malika. Thank you, Crawford. It's been very nice talking to you all.
Okay, goodbye everyone.